Hello and welcome to the Morning Filter. I'm Susan Dziubinski with Morningstar. Every Monday morning, I talk with Morningstar Research Services Chief U.S. Market Strategist Dave Sekera about what investors should have on their radars this week, some new Morningstar research, and a few stock picks or pans for the week ahead. So good morning, Dave. Looking ahead this week, you'll be keeping an eye on inflation. So what's the market expecting in terms of the CPI report, and what's Morningstar's outlook for inflation ahead?
Hey, good morning, Susan. Yes, we've got CPI coming out this week. Now, the headline CPI consensus is looking for 0.2% increase on a month-over-month basis and looking for a 2.6% increase on a year-over-year basis. Now, of course, core CPI is the much more important number of the two. That one also on a month-over-month basis, consensus is looking for 0.2%, and that should put that about a 3.2% year-over-year number. Now, 3.2% year over year, I mean, that would be flat from last month, but when I look at the longer term trend here, really still kind of stays on that long term, gradual decline that we've been seeing for quite a while now, really since, it peaked out in September of 2022. Now, longer term, I know our U.S. economics team is looking for inflation to continue to keep moderating over the course of this year and well into next year. In fact, we do have a bit of an out of consensus view that we're looking for inflation to fall below the Fed's 2% target in 2025 before it starts floating back up in 2026 back to their target.
Now, but even with inflation coming down, we're still seeing signs that the consumer is feeling pressure. So talk a little bit about that and what that could mean for the economy.
Exactly. So really, it's not necessarily the inflation right now that's pressuring the consumer. It's really, about 2 years now worth of just high inflation and the compound impact there that's really pressuring the consumers. Of course, we first, saw it really start to hit low-income consumers, and to some degree, it's really still hurting them, pretty badly when we look at a lot of the examples out there. So, for example, both Dollar Tree and Dollar General recently reported. And in their reports, they noted that consumers' spending, among their demographics, still is increasingly shifting their spending, to food items and other essentials and away from discretionary items. So both stocks, they sold off pretty hard after those reports. And really what's going on here is that, their margins are getting squeezed because discretionary products have much higher margins than food products. But it's not just the low-income consumers that are under pressure, and I think we've talked about this for the past 2 quarters now. We're seeing a lot of middle-income consumers also shifting their spending habits. So a couple of examples that we've highlighted in the past is Walmart. They've been reporting that they're seeing an increase in new consumers, coming into their stores. But even there, the spending is more focused on food and essentials and away from discretionaries. And even within that discretionary category, items that are more extravagant certainly are getting hit the hardest. And the example there is Starbucks. And I think we highlighted this the past couple quarters as well. In the first quarter, their same-store sales declined, and it's because traffic fell by 7%. And then they report another 2% decline in same-store sales in the second quarter. McDonald's, just another example out there where we're seeing consumers pull back, especially where they're not seeing the value proposition. So really from an economic perspective, this shift in spending, both how it's being spent as well as kind of the decline in the rate of growth of spending, is why our U.S. economics team is modeling in a slowdown in economic growth, not only this quarter, but going into the fourth quarter. And that slowdown really not stopping until the first quarter before slowly starting to come back over the remainder of next year. However, you see a lot of media headlines out there, really claiming the end of consumer spending and so forth. And I really just want to highlight, it's not like consumer spending is falling off a cliff. Unemployment still remains relatively low. We're seeing wage growth still on a positive trend. Hours working is still increasing. So from my point of view, really what I'm watching for both on individual stocks as well as the market is that unemployment rate. Now, if that unemployment rate stays the same, I think that's really going to kind of work into our view for the slowdown in the economy, but not for a recession. But if unemployment were to ratchet up quickly, then I think we would become much more concerned about the rate of growth and potentially a recession.
All right, let's pivot over to earnings. You have a couple of companies you're watching this week, Oracle and Adobe. So why are you interested in these two companies in particular, and how do their stocks look heading into earnings?
Well, with Oracle, not only is it rated, 1 star, meaning it's one of the stocks that we think is very overvalued. But when I look at our coverage, it's actually one of the more overvalued stocks in total under our coverage. Trades at a 45% premium to fair value. So right now, I think the market is treating it as an AI play, and to some degree, the company will benefit from the growth in artificial intelligence. But in our model, we think the market is just pricing in too much of a benefit than what we're seeing. The other thing with that name too is I think over time, our analyst is concerned that they will probably lose market share to new competition as well as potentially new database types. Adobe is an interesting one. Just taking a look at the chart and the performance of that stock. It had a pretty tough start, at the beginning of the year. It tumbled pretty hard until it bottomed out in early June. So just as a reminder, we had highlighted after that first quarter earnings call, we thought the company had made a mistake. The guidance that they gave to the market was just really what we consider to be especially convoluted. The market took that as a negative and just sold first and asked questions later. Now that stock dropped pretty far into 4-star territory at that point in time, but we had held our fair value unchanged. We just didn't see anything that would have caused us to change our longer term projections at that point. Since then, the stock has recovered pretty well, still trades at about a 12% discount. That puts it, I think, in the lower part of the 3-star range.
Well, let's catch up on some new research from Morningstar, and we have a good deal of ground to cover here, given that we didn't have a show last week. So first, let's talk Nvidia earnings. Now, the stock's down about 18% since reporting, and Morningstar maintained its fair value estimate on the stock after earnings of $105. So what did Morningstar think about Nvidia's report, and how does the stock look today after this pullback? Is there an opportunity here?
There's a confluence of factors that caused the stock, to pull back. More of them more technical in my mind than necessarily, fundamental. And I think what happened here is that the amount that Nvidia had beat earnings was less than the amount it had beat earnings, in the past. And then when we look at the guidance that it provided this quarter, I would say that guidance was in line with what the market was expecting, whereas in the prior quarters, that guidance was coming out, above, expectations. So really, from a sentiment point of view, I think that took the wind, out of that stock's sales, here in the short term. But from our point of view, from a fundamental basis, there's just really no change. We maintained our $105 per share fair value, puts that stock, at a 3-star level. In fact, I think the stock's almost trading like right on top of our fair value. Now, having said all of that, from a fundamental point of view, we still expect to see heightened growth for at least probably the next 4 quarters. The company is still supply constrained. They just can't make enough of these AI GPUs to meet demand. And demand's just going to remain exceptionally high. In fact, when you go back to some of these, their customers' earnings calls like Alphabet, they made a specific comment saying that the risk in AI right now isn't spending too much, but not spending enough. And if you look at the CapEx spending programs from Microsoft, Meta, Amazon, and so forth, they're all pointing to higher CapEx spending over the next 12 months or so. But it is a stock that is pretty fully valued. When you look at our valuations, our earnings estimates for this year for fiscal 2025 is $2.80 a share. Now that is growing very quickly, going up to $4.56 a share by fiscal 2027. But that stock is trading at a forward PE today of 45 times. Of course, that comes down to 28 times based on our 2027 earnings estimates. So again, a very richly priced stock, but of course one that is still growing very quickly for the next couple of years.
Well, let's talk about Salesforce. Now here, Morningstar inched up its fair value estimate on the stock by $5 after earnings, which brought it up to $2.90 per share. So what did Morningstar think of the report, and how does the stock look today from a valuation perspective?
Well, from a valuation perspective, it trades at about a 16% discount from fair value. That does put it in 3-star territory, although towards much closer towards 4-star than it is to anything else. So again, undervalued, but within that fair value range. So I think the takeaway here is that, from our point of view, second quarter results were good. Full year revenue guidance was maintained. Their profitability was raised slightly. And overall, I know our analytical team still considers Salesforce to be one of the better opportunities, for investing in, software over the long term. Really what's going on here, just a good balance between growth, margin appreciation potential, as well as a strong balance sheet.
Now, we had tech giant Broadcom reporting last week, and AI seems to be driving the company's growth this year. Morningstar held its fair value estimate on the stock at $155 after earnings. So what's the outlook for the company, and is the stock a buy today?
Well, taking a look at results, for the third quarter and looking at their guidance for the fourth quarter, our analyst noted that both were, in line with his expectations. Now, interestingly, the stock was trading right at fair value prior to earnings. It dropped pretty hard after that earnings report. And I think what's going on here is what we're seeing in a lot of these AI plays. It seems like the market was pricing in, better than expected results. And when that didn't materialize, I think we're seeing a lot of short-term traders, just punting their positions and just getting out. So from our perspective, our long-term growth thesis still intact. We held our fair value unchanged. So it leaves that stock trading at fair value in that 3-star territory.
Let's talk a little retail, Dave. Let's start with Dick's Sporting Goods. Now, the stock's up 43% this year, and that's after being down a bit after earnings. And that's kind of notable considering how sluggishly the specialty retail group overall has performed this year. So what's going on here?
Well, fundamentally, Dick's is actually still performing, quite well. I mean, they posted an increase of 4.5% in same-store sales, this past quarter. Margins actually came in, a little bit better than what we were forecasting. But as you alluded to, I think what happened here is the market just ran up, too far, too fast, and now we're giving back some of those gains. Plus, we think that stock is just way overvalued at this point. Our fair value, I think, is 114 a share, but it's now trading at an 80% premium to fair value, puts it well into that 1-star, territory. Fundamentally, we don't see this company as having an economic moat. It is rated as a no moat company. Now, granted, they are the largest, independent sporting chain, in the United States, but there's just too much competition out there from a lot of different channels, whether it's e-commerce, mass market, outlets, other specialty stores, and all of that is just going to limit its ability over the long term to be able to out-earn its cost of capital. And it's also one where, if we do kind of have this slowdown in consumer spending ongoing, I wouldn't be surprised to see the stock, remain on that downward trend as consumer spending, does soften over the next couple quarters as the rate of economic growth slows.
So sticking with retailers, Chewy stock was up double digits after earnings. And this was a name that you first recommended back in November of last year and then again in June of this year. So what did Morningstar think of earnings, and is the stock still a buy today?
Second quarter results were solid. A good combination of strong margin performance, modest sequential growth, an increase in active customers. So we still like the long-term story here. And this is one that, we talked about in depth, in a couple of those other calls. So really the synopsis here, the example of, how the pandemic skewed growth trajectories, for a lot of different companies, this one in particular. So if you remember, following the emergence of the pandemic, people were going into lockdowns, we had social distancing. We saw a big increase in the number of households with new pets. So growth at Chewy initially soared, that first year or two during the pandemic. Pet owners turned to Chewy not only to feed their pets, but buy a lot of, the high margin items, crates, toys, other accessories, and so forth. But then, of course, that sales growth just naturally started to slow down. Now, we think that a couple years past that slowdown, we're getting to the point where that growth rate for households of pets should begin to increase and getting back towards, historical normalized levels. And we expect that Chewy will start to see some sales growth reaccelerate in 2025. So stock is up 15% since the June recommendation, up 43% since that November recommendation. So right now it trades at about a 13% discount, but that does put that in the 3-star range, meaning we think it's within the range that we consider to be fairly valued at this point.
Now, another one of your picks back in that November 2023 show that was a specialty retailer was Bath & Body Works. Now, the company reported earnings in late August, and the stock took quite a tumble. So what happened, and do you still like the stock today?
Yeah, I mean, it's really unfortunate. This stock has really round-tripped all the way back to where it was when we first started talking about it, last November. So last November, I think it was somewhere in that 3-handle range, $30 or so. Moved all the way up to $50 as the story was playing out. But now, as you mentioned, it's all the way back to, 30 again. So it is a 5-star rated stock at this point. Trades at, I think, slightly over a 50% discount to fair value. And to some degree, I think the market right now is just throwing this stock out along with all the other discretionary product retailers. But we just don't see it that way. We don't think the current trends are going to be indicative of the long-term fundamentals here. I know talking to Jamie Katz, who covers this stock, she looks at their products really as being more an affordable luxury, and that should, hold up, even in a time period where we're looking for consumer spending, to slow down. we're going to be coming into the holiday sales, period here, relatively shortly. And from that perspective, we think that they have a good assortment of, products at lots of different price levels. Plus, these are gifts that people look at that they think, have appeal from a brand point of view to give, during the holiday season. So management did guide for the year for their sales to be down, 2 to 4%. It's a little bit more than what we were expecting. Our forecast was for a 2% decrease. The other thing that management did here is they tightened up their EPS guidance for the year. So it's now $3.06 to $3.26, per share. So I'd note that they brought the top end of their guidance down. They actually raised the bottom end of their guidance by a penny. So that actually gives me some comfort here that they're really very comfortable with the downside, in earnings here in the short term. And I have to talk about this too, but granted, our valuations are not driven by PE ratios, but sometimes I do like to look at them to see how the market, is valuing these stocks. And at the midpoint of that current guidance, the stock is only trading at 9 times forward earnings. So, pretty undervalued in our view.
Well, in other new research, I want to ask you about your September stock market outlook, which viewers can access via a link beneath the video. Now, when you published the report at the beginning of September, the stock market looked fully valued. But with a full week of September market activity behind us now, and that wasn't a great market activity, do stocks still look fairly valued? And how should investors be thinking about their overall equity positions today?
Yeah, we came into September, the market was trading a few percent, above a composite of our fair values. Market was starting to feel a little bit overextended after the big rally we had after the sell-off, at the beginning of August. As you mentioned, we had a pretty tough week in the market last week. The market retreated, I think, about 4%. So at this point, we're now back to fair value, maybe even, slightly below fair value. So when I look at our valuations and really look at the macro dynamic factors, that we're thinking about over the next couple quarters, I think investors should be at whatever their targeted equity allocation is as a percentage of their assets, in their portfolio. And just looking forward, what we expect to see is, inflation continuing to moderate, long-term interest rates on that long-term downward trend, and of course, the Fed to start easing monetary policy, after they meet next week. So really, I think, those tailwinds should be enough to offset the headwinds that we're seeing from that weakening rate of economic growth over the next couple quarters. Having said that, could be choppy here in September and October.
Yeah, let's talk a little bit about that, because you do make a note of that in your outlook, that you really wouldn't be surprised to see some choppiness this month and in October. Go into that a little bit.
It's really much more from a technical point of view. Now, September historically has been, one of the toughest months, of the year for equity markets. So I think that's in the back of a lot of people's minds. And then thinking about October, I expect a lot of traders are going to look to take risk off the table, exit positions probably in the second half of October, once we get closer to the U.S. presidential elections. But from a fundamental point of view, while I think that there's no reason for companies to miss their third quarter earnings, I am still very concerned about what they might be guiding towards, in the fourth quarter. Management teams, may be seeing the same things we're seeing with that slowdown in the economy. So they may look to bring expectations down, for earnings for the fourth quarter, by way of, what we're thinking for the economy. Right now our U.S. economics team is only projecting, a 1.2% real annualized rate of GDP for the fourth quarter. So pretty low, almost kind of stall speed, for the economy. And then the other thing I'd note too is that while spending on AI, is still ramping up, what we've seen this past quarter is that these AI stocks are no longer outpacing expectations. And, in the fourth quarter, in the third quarter numbers, coming out in the fourth quarter, just meeting expectations, might not be good enough, based on where these stocks are currently trading. So we could see some softness there too if they just meet expectations and don't bring guidance up further.
Now, you talk quite a bit in your outlook about the rotation that we've seen in the market since July. And you said several times on the show during this first and second quarters that, based on valuations, you thought some rotation was likely, but it certainly has been dramatic over the past few weeks.
Yeah, so if you remember, like in our third quarter outlook, we specifically noted that, from our point of view, a lot of those AI stocks had run their race, that they got up to valuations that were either fully valued or in many cases, getting to be overvalued. But we still highlighted that valuations for value stocks as well as for small cap stocks remained, very attractive. And I'd say attractive not only from, an absolute point of view, but also from a relative point of view as compared to, the rest of the market. So it looks like July really is marking the beginning of that rotation out of those, overvalued, overextended, large cap AI growth stocks. And what we've seen is that money to go into value stocks, as well as down in capitalization into mid cap and small cap. So quarter to date through the end of August, value stocks were up 8.3%. Growth stocks were only up 2%. And in fact, within the growth category, large cap growth stocks were actually down 0.6%. By capitalization, small cap stocks finally had their day in the sun. They were up 6.7%. Mid caps also doing very well, up 6.4%. And that large cap category lagging at only being up 3%.
Now, we've seen a revival in defensive stocks during the past several weeks, including the healthcare sector and the consumer defensive sector. So how do valuations look in each of those sectors after their rally?
Well, at this point, we think both of those sectors are overvalued. The consumer defensive sector is very expensive. In fact, it's the most overvalued sector in our view right now. Trades at a 15% premium to fair value, a sector you typically don't see getting up, into those kind of ranges. And healthcare also slightly overvalued, trading at a 5% premium. Now, to some degree, I have to note that when I look at these sectors overall and look at the individual stocks, there are some stocks, some large cap stocks in these sectors that are skewing these sectors. So, for example, in the consumer defensive sector, if you look at Costco, that's a 1-star rated stock, trades at a 72% premium. I think it trades at like a 50 times forward PE ratio. In healthcare, Eli Lilly has just been a phenomenal riser, but again, it's a 1-star rated stock, trades at a 56% premium. And because the market caps of these companies are very large, especially within the individual sector, their valuations do at this point in time tend to skew the sector valuation higher. So it's one of these situations where the sector itself is overvalued, but largely because of a couple of individual stocks that have brought those valuations up. Both sectors do still have some individual stocks that we think are quite still attractive. So maybe a better time for stock pickers in the individual sector as opposed to people that just use the ETFs for the sector exposure.
Now, let's talk utilities, Dave. Here's another sector that's considered defensive, and they've performed really well this year. And as a result of that, your view on the sector has changed. So talk a little bit about that.
Well, I mean, even before that, I really just have to call out, Travis Miller and our utilities team. They really called this one, so well over the past year, really last October, essentially pounding the table, just talking about how utilities, overall had just gotten to be way too undervalued. And in fact, at that point in time, I think they had noted that they were trading at some of the lowest valuation levels, compared to our valuations, over the past decade. Since then, utilities have benefited, not only because they're considered defensive, but they really got caught up and are considered, that second derivative play on artificial intelligence. AI computing, of course, requires, multiple times more electricity than traditional computing. So, of course, we're going to see, long-term growth in electric demand, as AI becomes a larger part of, the technology sector. However, year to date, the sector's up now over 22%. It now trades at an 8% premium to fair value. That compares to a 15% discount last October. So at this point, I think the utility sector has probably run its race. It's now a good time to take some profits, maybe underweight that sector, but certainly, if nothing else, swap out of some of the stocks there that have done really well into maybe some of the ones that we still think have further room to run.
Now, another sector story in August was the continued revival in real estate stocks. And here, David, it seems like you were just saying that real estate was the most unloved sector, but that's not the case any longer. So tell us what's been going on there and what valuations look like today.
I think this is just a really good example of just how once the market, starts to correct, just how fast it can go, and why you want to have an allocation to these undervalued sectors, even when it doesn't look like they're going to perform, anytime soon. Because once they start to move, they can move, really fast. And I really like this case too, because you were able to collect, a pretty high dividend, while you waited for it to work. As you noted, just as recently as I think it was in May, the real estate sector was trading at a 17% discount to fair value, but it was up 7.5% in July, another 5.4% here in August. So at this point, from a sector perspective, it's now pretty close to fair value. Having said that, there are still a number of individual stocks that we like that are undervalued and still pay relatively high dividend yields.
All right, well, now it's time for the picks portion of our program. And today we're talking stock swaps investors can consider. So you've brought us 3 overvalued stocks to sell and 3 undervalued stocks to buy instead. So first, you suggest selling Costco and buying Kraft Heinz. Explain this swap for us.
Yeah, I mean, Costco, it's just an example of, great company, but overvalued stock. Now, we rate the company with a wide economic moat, medium uncertainty, looks great from a fundamental point of view, but the stock right now is rated 1 star, trades at a 72% premium, to our fair value. And just as an indication of just how overvalued we think that stock is, it currently trades at about a 50 times forward PE ratio as compared to our earnings for this year. So again, great company. Personally, anytime we go to Costco, we spend a lot more money in our household than we probably should, but just can't justify, that kind of multiple on this stock. Now, Kraft Heinz is a different type of example. It's a company that we think is turning itself around. We're looking for improving, fundamentals. In fact, we recently upgraded our economic moat rating to narrow from none last June. So historically, a number of years ago, Kraft was bought out by 3G partners. 3G, when they went in there, they overemphasized, short-term profitability, over, building long-term economic value in our mind. And initially it worked. They were able to cut costs, they were able to improve margins. But once that ran out of steam and really people started to see some deterioration in the fundamentals, that stock began to slide and slid pretty dramatically thereafter. Now, over the past 5 years, Kraft has been going back, really revamping its strategy, focusing on building that long-term value, improving efficiencies, reinvesting back into their brands, improving their category management. So we think this is a company that's back on the right track. The changes it's made, we think, will strengthen its intangible brand assets, over time. And that was enough to bring our economic moat rating up. And it also looks like they've also strengthened their cost structure. And I think that's really going to help here, in the current period that we're in. Overall, 5-star rated stock, 37% discount, nice healthy 4.5% dividend yield while you wait for this one to start working.
Now, in healthcare, you suggest swapping out Eli Lilly and picking up Medtronic instead.
Yeah, Lilly, phenomenal growth story, based on its weight loss drugs. But again, another one where we think this market has just gotten way ahead of its long-term earnings potential. Yes, we agree there is a very large total addressable market out there for the weight loss drugs, but there's also going to be a lot of competition from competing drugs, that are coming online, not only here in the short term, but in the medium term as well. So when you look at the valuation here, I mean, there's just no room for any error, especially if there were to be, any kind of side effects, if patients aren't willing to stay on the drug, for the long term. So when I look at this one, the stock has, tripled since the FDA really first approved, Mounjaro. Stock is currently rated 1 star, trades at a 56% premium to our fair value. So within the healthcare sector, I'm going to highlight Medtronic. Now, we've talked about this one for a while, and it really seems like maybe this is a story that seems to be taking a while to work out, but we still see a lot of value in Medtronic. It is the largest pure play medical device maker. We think it's one of the best healthcare companies, positioned, for the continued aging of the baby boomer generation. Company makes medical devices for chronic diseases, things like pacemakers, defibrillators, heart valves, stents, insulin pumps. So overall, we rate the company with a narrow economic moat and a medium uncertainty. Taking a look at our model here, we're looking for a 5-year compound annual growth rate of 4.5%, operating margin improvement, earnings growth of 11.3%. Stocks trading at about 16.5 times this year's earnings estimates in our view, decreasing to a little bit over 15 times next year. So overall, trading at a pretty healthy, 20% discount to fair value, puts it in 4-star territory. And again, pretty decent dividend yield of 3.1%.
And then lastly, among utilities, you'd scale back in Southern and buy Evergy, which I think is a new name that we haven't talked about on the show before.
Yeah, Southern, when I look at that stock, it's up 26% thus far this year, and actually puts it at a 26% premium to our fair value, enough to push it into that 2-star category. Again, just another case where we think the market has just gotten ahead of itself and pricing in too much growth. And yes, Evergy is a new name that I don't think we've ever talked about before. Evergy is a regulated electric utility in eastern Kansas and western Missouri. And our utilities team, recently highlighted that one in note, just highlighting it is, I think one of the cheapest U.S. utilities right now in our point of view. It's a 4-star rated stock, 8% discount, dividend yield of 4.3%. Fundamentally, we think that the fundamentals here are improving enough, actually could lead management to boost their earnings growth outlook later this year. And if they do so, that actually could be a really good catalyst to help the stock move up.
Well, thanks for your time this morning, Dave. Investors who'd like to learn more about any of the securities that Dave talked about today can visit Morningstar.com for more details. We hope you'll join us for the Morning Filter next Monday at 9 a.m. Eastern, 8 a.m. Central. In the meantime, please like this video and subscribe to Morningstar's channel. Have a great week.